People often think that superannuation is complicated, but it doesn't need to be. Superannuation is just the technical name for your money that's invested for your retirement. There can be a few added benefits and incentives as well, like insurance cover and potential tax savings. We're going to run through our super health check and highlight some of the important choices you can make when it comes to your super. Now let's take a closer look at how super works and get your super sorted. Let's take a look at what comes into your super account first. Generally, your employer pays contributions into your super account throughout the year. You may also consider making some of your own contributions to help boost your balance. Rollovers and transfers are when you move the balance of your super accounts you may have into another super fund to increase your savings. Next, we have investment earnings. Money that goes into your super is invested to help grow your retirement balance over the long term. Depending on which investment option you choose and how those investments perform, your super balance will go up or down every day. And finally, let's look at the outs. Regardless of where your super is held, most super funds will charge fees to administer your account. These typically come in the form of administration and investment fees. Taxes are unavoidable, unfortunately. However, your money within superannuation is taxed at concessional rates, meaning you generally pay a lower rate of tax within super, compared to the income tax that applies to your pay. And lastly, insurance premiums. Some people are unaware they may have insurance within their super, and even fewer are aware they're generally paying premiums for that insurance. Our Super Health Check helps you focus on some really important areas within your super account. We will spend some time helping you become more familiar with these key superannuation topics. We encourage you to work through this Super Health Check to find out what's important and see if your super is in good health and working for you.
One of the best ways to build your super balance is by making contributions. Contributions that your employer pays into your super on your behalf are called the Superannuation Guarantee, or SG for short. The SG rate is determined by the government and has increased over the years. The rate is currently 10% of your ordinary time earnings. Once these contributions are received by the super fund, they are generally taxed at a rate of 15%. Many people find that relying solely on their employer contributions isn't enough to build their super balance to what they'll need for a comfortable retirement. That's why you may also consider making some of your own contributions. You may have heard of salary sacrifice. This is where you direct an amount of your before tax income to your super account to save on tax and to grow your super balance. Let's have a look at an example of how this works. Imagine you had $100 of your salary or wage each month that you were able to save for your retirement, but you're unsure of the best way you should go about it. Should you save it yourself by having the $100 less any income tax paid to you, or should you save it through your super? If you decided to save the $100 yourself, your employer will first deduct the required amount of tax. For many Australians, this is 34.5%, including the Medicare levy. This leaves you with about $65.50 in your bank account that you can save for your retirement. If you're anything like me, you might know that not touching that money and saving it is easier said than done. Another way you can save for your retirement is via salary sacrifice to your super. In this example, that same $100 would no longer be taxed by your employer, rather your super fund will deduct tax at the concessional 15% tax rate, leaving you with $85 net in your super account. Once the money is in your super account, the temptation to spend it is removed because super is generally accessible only at retirement. You can see straight away after 1 month that you're left with more money in your super because of the lower tax rate. Over many months or years, this can really start to add up. To start, stop, or change a salary sacrifice arrangement, this is generally organised through your employer payroll officer. If you're unsure if a salary sacrifice arrangement is right for you, you may wish to obtain financial advice. Just remember, the government has some rules in place that limits the amount of salary sacrifice and employer contributions that go into your super account each financial year, taxed at the 15% tax rate. If you haven't reached your contributions cap in previous years, you may be able to utilise some of the unused amounts. You're also able to contribute to your account by making after-tax contributions. These are also known as personal contributions. Limits also apply on the amount of personal contributions you can make each financial year. One of the reasons people may choose to make after-tax contributions is to receive the government co-contribution if they're eligible. Depending on your income and the relevant eligibility criteria, the government may contribute up to 50 cents for every dollar of your personal contributions made, up to a maximum of $500. This will be allocated to your super account once you've finalised your annual tax return. Depending on your income, you may also be eligible for the low income super tax offset.
We understand people typically have had a few jobs along their journey and may have more than one super account because of this. If you have more than one super account, you may be paying fees and potentially insurance premiums for each account you hold. It's never been easier to bring all your super together. You can use your MyGov portal to find any lost accounts you may have forgotten about. Just remember, by consolidating your super accounts, you may lose benefits, including insurance cover, you have through any of your accounts which are closed as a result. Speak to us or your financial advisor first if you are not sure about the impact of consolidation for you.
Many people forget that their super is invested to help grow their account balance for retirement. How your super investments perform over the long term is going to be one of the biggest factors that determines not only your account balance, but how comfortable your retirement will be. Some key questions you might like to ask yourself when reviewing your investments may be: how long will your super be invested? The length of time over which your super balance will be invested may help you choose which investment option is right for you. For example, someone who is considering retirement in the next 2 or 3 years may choose to be invested differently to someone who can't access their super for 30 or 40 years. Diversification is the concept of reducing your investment's overall exposure to risk by having your balance invested in different asset classes or options. You might like to think of this as not having all your eggs in the one basket. This is important to help achieve stable returns over the journey. Have you made a choice? Did you know that if you don't make an investment choice, your super fund will make the choice for you? It's important to remember you have control over your super and you can choose how it is invested. Why should you care? Your super may already be or may become one of your largest financial assets. So knowing how your super is invested and how it's performing is really important. If you're a Statewide Super member and haven't made a decision where your super is invested, your balance and future transactions will be invested in Statewide Super's default investment option. This is called My Super. Around 85% of our members have some money in the My Super option. My Super is a diversified investment option with money invested in a variety of asset classes like shares, property, infrastructure, cash and bonds. The My Super option is considered medium to high risk, so may not be right for everyone. If My Super isn't right for you, it's important to know you're able to review and switch investment options. At Statewide Super, there are 10 investment options to choose from, ranging from low risk to high risk. Each investment option at Statewide Super has different expected volatility or risk and expected returns. If you choose to invest in an option which is low risk, you might expect a lower rate of return, whereas an option with a higher level of risk would generally have a higher expected return over the long term. Each investment option has daily unit pricing. Depending on how your option has performed, this unit price may go up or down in a similar way to a share price. You can choose to invest in one or more options for your account balance and for your future transactions, which includes your super contributions. If you're thinking about changing your investment choice, you can make a switch at any time through your online portal or by contacting us. Investments can be a bit overwhelming. That's why Statewide Super members can speak to us and get advice about which investment strategy is right for them.
Our most important asset is ourselves and our ability to earn an income to pay for everything. We typically insure our home, its contents and our car, but sometimes we forget to insure ourselves. Often, many of us are unaware that we may hold insurance cover through our super account. Insurance helps with the financial burden that can arise when unfortunate events take place in our lives. These what-if moments can affect us all differently, so it's important to think about how your life would be affected if any of these events were to take place. Insurance is very personal. Making sure you consider your own circumstances is important to ensuring you are adequately protected. For example, have you thought about how you would be able to get by if you are unable to work for 12 months? Or how your family would cope financially if you were to pass away? At Statewide Super, there are 3 types of insurance cover available for our members, subject to some conditions and insurance eligibility criteria. Let's take a look at each one and see how they work. Death cover is a lump sum amount that is payable in addition to your super balance to your beneficiaries in the event of your passing. Total and permanent disablement cover, commonly known as TPD, is a lump sum amount in addition to your super balance, which becomes available to you if you have an accident or illness and are never able to return to the workforce. Income protection is a monthly benefit paid to you if you have an accident or illness and are unable to work for a temporary period. The income protection benefit is payable for up to 2 years. It's important to remember that income protection through your super account only relates to your health and won't cover you for loss of employment. If you hold insurance through your statewide super account, you will be charged monthly premiums, which are automatically deducted from your super balance. You can choose to cancel or change any default insurance cover you may receive at any time. There are also options to apply for additional cover and to transfer other existing cover you may have. We are all at different stages in our lives with unique priorities and goals, which will often shape our insurance needs. Make sure your cover is right for you and your personal situation. Waiting periods apply to TPD and income protection insurance. You should make sure you understand how long the applicable waiting period is before you will start to receive benefits, should you make a successful claim. We've spoken about the 3 types of cover available through your super account. Now let's have a look at what determines the amount you pay for your cover. At Statewide Super, if you have insurance cover in place, the monthly premiums deducted will be determined by your employment duties and occupations. When default insurance is first provided, your occupation won't be known to us, which means you pay a standard rate of insurance premiums. If you're an office-based worker, you can apply to update your occupation category, which may reduce your insurance premiums. It's worth taking a look. If 90% of your duties are undertaken in an office environment, you may be able to apply to the insurer to have your occupation category reclassified as white collar, which may result in your monthly insurance premiums reducing. Our professional category requires 100% of your duties to be undertaken in an office environment. You to earn in excess of $100,000 per annum from your profession and hold a tertiary qualification relevant to your role, or be a member of the relevant professional institute of your occupation, or be a senior member of your employer's management executive team. If eligible, your insurance premiums may reduce even further. Applying to make the change is simple. You can apply via your Statewide Super online account or complete the occupation category form available on our website.
One of the most important aspects of super accounts that is often overlooked is a beneficiary nomination. A beneficiary is the person or persons who receive your super balance and any insurance benefits if you were to pass away. Many people forget to nominate their beneficiary or keep it up to date. Leaving clear instructions can make it easier for your loved ones should the worst happen. The government has some rules around who you can validly nominate to receive your benefit. You can nominate your spouse, any of your children, someone you're in an interdependent relationship with, or any person who is wholly or partially financially dependent on you. You're also able to nominate your benefit to be paid to your legal personal representative. This means you would like your super and any insurance benefits to be paid to the executor or administrator of your estate and then be distributed according to your will. There may be different tax implications for the beneficiary you nominate to receive your death benefit. You may wish to obtain advice before determining who to nominate. Now we know who we can nominate, let's take a look at the 2 ways we can make a nomination. A preferred nomination, as the name suggests, is your preference only and isn't formally binding on the super fund trustee. A preferred nomination will be taken into account when the trustee determines through a claim staking process who to pay your death benefits to. This nomination can be made through your Statewide Super online portal or via our app. The other option is a binding nomination. A valid binding nomination is legally binding on the super fund trustee, meaning if you were to pass away, Statewide Super will pay the benefit in accordance with that nomination. Benefits are generally paid in a more timely manner as the trustee will not need to undertake a claim staking process. This type of nomination must be made via a specific form and the original document returned to the fund. Binding nominations remain in place for 3 years. After this period, they then lapse and revert to a preferred nomination if not renewed. We'll send you a reminder before the 3 years pass to prompt you to update your binding nomination, but remember, you can update your nomination at any time. Nominating a beneficiary may only take you a few minutes, but it can be one of the most important things you can get sorted on your super account.
All super funds charge fees for administration or investment costs, so it's important to know how much you are paying, how it's deducted, and what you are paying for. More broadly, it's also worth understanding what other services such as utilities and other financial services are costing you. Spending some time reviewing what you are paying will ensure that you are not paying more than you need to, and you might save yourself a few dollars. Your annual super statement, utility bills that come in, any direct debits you have in place, and your credit card statement are good places to start. At Statewide Super, we understand that your super may not be something that you look at regularly, but taking some time to review it, especially when circumstances in your life change, is a fundamental part of getting your super sorted. One of the easiest ways to do this is to ensure that you have access to your account online. This allows you to see your balance, check your transaction history, and to see how your funds are performing. We also encourage you to download the Statewide Super app so that you have access to your super at your fingertips. Whether you have some simple super questions, require some personal advice about your Statewide Super account, or would like more comprehensive financial planning advice, Statewide Super has you covered. Advice when you want it, how you want it. Whatever the stage of your working life, the more you know about your super, the harder you can make it work for you. Hopefully, you are now one step closer to getting your super sorted. If you need any help or would like to get some advice, give Statewide Super a call and talk with your local super team. We're here to help you create yourself a super future. Any advice contained in this presentation does not take into consideration your financial situations, goals, or needs. You must consider the appropriateness of the advice prior to acting on this information. Please seek advice or read the Statewide Super product disclosure statement prior to investing.